So, why are we here today? When Lisa, Walder and myself were thinking about the types of topics that we wanted to put out to our network, ultimately a topic of conversation with the recruitment business owners that we tend to speak with is how can they create value and what type of exits or events they can go through in the long term for their business. So today's panel have got 4 different experiences of the types of events or solutions that they've gone through when exiting a business or perhaps going through an acquisition. Without further ado, I'm going to let them all introduce one another rather than me do it, because I'll probably murder it. So please start, Chris.
Hi, Chris Jackson, Understanding Recruitment, a business we set up around 18 years ago, purely based in tech, based in the UK and US. Went through a EOT around 3 years ago, and that's what I'm going to be talking about today to share my experiences.
Morning. I promise not to sing. My name is Alex Arnott. My background is I built and sold 3 companies, including one in recruitment, which grew to about 120 people in 4 countries. I currently sit on the board of about 25 recruitment companies globally, everything from startups, the largest at about $250 million, and I've led 25 successful exits for other founders to date.
Hi everyone, Tom Cosby. I'm an advisor at RG Corporate Finance. We're a Newcastle-based but nationally operating corporate finance boutique, operating across a range of sectors, but human capital probably makes up about a third of our work, and probably one of the most active advisors in this sector. So advising on a range of acquisitions, disposals, fundraisers, and MBOs.
Morning everyone, I'm Richard Draper. I'm an exec search consultant with about 30 years experience in the UK, US and across Europe. I, many years ago, established a business with 2 partners, grew and scaled that, bought them out on their way, and ended up selling it in 2016. Rycroft Glenton were one of our partners that helped us take us through that. Alex Arnott was one of the other advisors we had on the team. So I'm here to talk a little bit about that experience and what I learned along that journey. And then post-deal, joining a PLC, helping those guys to scale internationally before joining a European business today where I'm also helping them scale.
Thank you very much. Appreciate it. So Tom has a sort of slide presentation he's going to go through about some of the levers of value for businesses.
Awesome, thanks. Yes, I'm going to bore you to death initially with a bit of a sort of overview of fundamentally how we value recruitment businesses. With that being the sort of foundation, we then build on that, talking about how we can move those levers in order to get your recruitment business worth more effectively. Very quick overview of RG, I don't just summarize it then, but effectively we are a corporate finance boutique. We are part of Rycroft Glenton accounting firm, which is a 120-year-old accounting business. We're based in Newcastle, but we have offices in York now, and I sort of head up the London office, which is a team of 1 currently, but it is. Yeah. It's my baby. So we typically advise businesses as a sort of range of sort of 1 million EBITDA up to 10 is like our sort of sweet spot. So offering that sort of lower mid-market, as we call it. And there's a transaction size, particularly between 5 and 75 million. So working with fairly mature businesses down to some more early startups on a range of processes. So we're talking today a bit about valuation, kind of linked through to the sale of businesses, but also we do a lot of work working with acquisitive businesses. So we can see both sides of the story, which gives us kind of good insight. So that's Rycroft Glenton. A few sort of transactions, obviously our recent transactions here. Just kind of summarise it effectively. We work on all types of transactions. So you've got Petroplan in the middle there. We sold that to TXM last year. That's a sort of trade sale. We sold DMJ to Omni Partners. That's a private equity style transaction. Unite People was an MBO with Aldermore. M2 Education we sold to a Swedish-backed business. So a range of sectors. We'll talk a bit about today about how those different transactions vary. If you're selling to trade, selling to private equity, selling to private equity-backed trade. I'm going to start off with talking a bit about fundamentally how you value a recruitment business. So when talking more broadly about how you value businesses in general, there's really 3 main ways of doing it. So you've got an earnings-based or revenue-based valuation, where you apply a multiple to a profit measure or revenue measure. You've got discounted cash flow, which kind of works only when you look at businesses which have sort of 20 years foresight of revenues. You don't typically see that in recruitment for all the obvious reasons. I think if you could predict 20 years in the future, you'd be, yeah, please come talk to me. And last of all, net asset valuation. Again, not big in recruitment because in recruitment businesses, the assets are the people, fundamentally. So here we'll talk about an earnings-based valuation. And here's effectively the mathematics of it. So we start off by taking the business's maintainable earnings. So the maintainable earnings are the earnings that an acquirer would basically get themselves post-transaction. We then apply that by a multiple, which is essentially a number, to get the enterprise value. The enterprise value, think of as effectively like the goodwill value. It's the sort of value placed on the profits of the business. So that's how much value they're placing on the profits they're going to be getting from your business in the future. We then want to take that enterprise value through to the equity value, which is how much your shares in your business are actually worth. And to do that, we add cash, we deduct debt, and we make an adjustment for normalized working capital. Normalized working capital, I won't go into too much detail, but effectively it means that you need to leave the business with the level of working capital it needs to operate. What it means is you can't just pre-transaction collect all your debtors, pay none of your creditors, have a whopping big cash balance, and take that and run to the hills. You have to leave the business with, how it normally operates. And that gives you your equity value, which effectively, how much value the shares in your business actually hold. So to break down these sort of mechanics, so maintainable earnings, fundamentally in the M&A market, the main measure of that is adjusted EBITDA. So EBITDA is earnings before interest, tax, depreciation, and amortization. I can still remember, Alex. So that's sort of the basic foundation. So when you're looking at your P&L, that's the kind of starting number you want to get to. You want to get EBITDA, which is profit before interest, corporation tax, depreciation, and amortization. That's the sort of the starting point. And you then want to make adjustments to that to get a more maintainable figure. And what I mean by maintainable is things like one-off exceptional items. You want to be removing those or extracting those. So for examples, if you had some really high legal fees in 1 year because you had some sort of some compliance issue, you could add those back as a non-recurring cost. Because in the future, that cost is not going to be, it's not an annual cost to the business. Likewise, if you recently moved offices, it might be a big cost for that move. Again, these are sort of add backs. An important thing also is things like direct remuneration. So if you pay yourself an excessive remuneration because you're the sole shareholder, you're the sole director, you can adjust that to what we consider to be more like a market rate level of earnings. Other things to think about as well, particularly for recruitment businesses, things like recruitment costs. If you invested significantly in 1 year to hire 10 new heads, in that year, your profit has been softened by that big investment. But going forward, that isn't going to be an annual cost of business. So you consider sort of stripping that out as well. Things like non-performing hires. So for example, if you hired a very expensive consultant, paid a lot of money to hire them, paid on their salary, but actually they didn't perform, they never actually really got going, they were then exited during that year, you could then add back that cost. Because effectively, you brought in cost, it hasn't contributed to the business's profit at all. And therefore, that's a sort of good one, of course, you can add. If you employ a very expensive NED, like Alex here, that post an event, NEDs might not be employed by the business anymore because they're helping them get to an exit. So going forward, that cost could also be removed. So they're the add backs. You do also need to deduct things like income that won't be received going forward. So government grants, you don't often see in recruitment businesses, but sometimes non-trading income. Say you sublet out part of your office space and you're getting income from that. That's not income generated by the business, so that should be removed. The biggest one thing about here, which is one of the things that owners need to consider, is shareholder remuneration. Sort of the other point I made before. So if you are drawing from the business purely through dividend, there's no cost actually going through your P&L. But post-transaction, you would be an employee. Or if you exited, they'd bring in an MD to run the business for you. So then that cost needs to be brought in. So for example, if a market rate salary in your sector, in your region, is 100,000, you need to put through 100,000 of costs. The business needs to be basically sold fully costed. So post-transaction, all those costs are included. And that gives you the adjusted EBITDA. To then work out what the maintainable figure is, because each year you'd work out what that adjusted EBITDA figure is. You then want to work out, right, what is the going forward earnings level. So the most important thing here is if the business is a fast growing, scaling business, your profit's going up every single year. Ideally, you want your business to be valued on a forward-looking, because the forward-looking one's going to be higher. If you want that's going to be the case, you need to make sure you've got a detailed financial forecast in place. That's probably a key message for SME businesses. We often see this with clients where they haven't got a robust forecast. And I appreciate in recruitment it can be difficult, but even a one-year forecast which you're working towards and is updated regularly, that's something to look towards. And if you've got that forecast in place, you can then see your business valued based on a sort of forward-looking perspective. Without that, a buyer, they can only look historically, and that's going to be backwards looking and probably lower levels. And you have to think about fluctuations. So if your profit is stable each year, you're going to get a better value. If, for example, the year before was really, really low, this year it's better, it's going to be hard for a buyer to be convinced that that new level is maintainable. So they might use a blended average, which lowers things. So again, stable performance is obviously going to be beneficial. So that's how we determine the business's maintainable earnings. The second bit is the multiple. So what do we times it by? And this is very subjective. How we look to determine this ourselves as CF advisors, we look at two sources, which is one, recent transactions. So recent transactions that take place in the market. Sometimes the multiple is actually disclosed if it's acquired by a listed business where they have regulatory requirements to disclose them. And the other example is comparable quoted companies. So in the UK, there's plenty of listed recruitment businesses. I've included 3 examples at the bottom there. So these are multiples you can just find online for these businesses. These were as of yesterday. And these are the EV to EBITDA multiples that will get applied. The one caveat I would include here is a privately owned SME in the UK won't be valued at 14.6 times. As much as we would love that, these businesses are large, very scaled, huge international businesses, and they are publicly listed. For those kind of 3 factors, they have higher multiples than privately owned businesses because you can just buy and sell these shares really easily, and the businesses are huge and very profitable. Smaller businesses that can't be traded so easily are discounted results. So typically, we discount them between sort of 30 and 40% to get it down. And just some factors that kind of impact on, I guess, where in sort of multiple range. Actually, just to come back to that sort of slightly. So I think it's reasonable to say that I think within the recruitment sector at the moment, sort of small owner-managed businesses, a typical multiple is between 4 and 6 times. That's the most likely multiple you would get. As you kind of scale up, past the sort of 2 million up into 3 million mark, that will increase perhaps up to 7 times. But broadly, it's 4 to 6 times is kind of the standard at the moment. And where you fall in that range of 4 to 6 is impacted by a few points which I've mentioned. So, for example, where is the business in its life cycle? So fast-growing businesses with big potential are going to be valued at a higher multiple. Businesses with recurring or particular revenues, again, have a higher multiple. This features a lot in conversation about recruitment businesses when we're talking about perm versus temp. So you hear all the time, investors and acquirers like temp recruitment because it is more recurring and it's more reliable, it's more predictable. The challenge with perm, what can be higher margin, is it's difficult to know what's going to happen next year and actually how reliable that's going to be. So if you can demonstrate you've got sort of long-standing recurring clients, then that's going to add to your business. Again, how mature and scaled it is, larger businesses warrant higher multiples. There's large businesses, there's less risk, the business is going to go backwards, there's more contingency in there, so again, they're valued better. The experience of the SMT, particularly important, particularly for owner-managed businesses. If you have a senior management team in place that are fully incentivized, really experienced, they run the business without you, again, there's less risk in acquiring a business like that, and therefore businesses are willing to apply a high multiple to it. And actually concentration risk. And this cuts through so many different things. So it means concentration of clients. So you want to have a diverse client base. You don't want just one client providing half your revenues. Also employees. So you don't want to have, just 2 consultants generating most of your NFI. You want that to be well spread. And all these are really summarized by, I guess, risk and reward. So the higher the risk of the business performance going backwards, the lower multiple. So the more security you can have of future performance, the better multiple you're going to have. And rewards, so bigger, faster growing businesses are more attractive. They're going to have a higher multiple as well. Okay, this is real sort of accounting stuff here. So this is the balance sheet adjustment. This is how we kind of get from the enterprise value to the actual value of shares. So just quickly go through these. So debt-like items. So you want to deduct all debt-like items from that value previously determined. So that's things like bank loans, it's things like overdrafts, things like your corporation tax. And a big one in recruitment businesses is ID facilities. So this is a slightly subjective point. If I'm advising on the buy side, I'm always treating an ID facility as debt-like item because I was going to reduce value for it. If you're selling a business, you want that to be treated as working capital because your ID could be a significant balance and you don't want that to deduct from your value. Because these adjustments are pound for pound. So say your bank loan is £1 million, that's £1 million off your value. So CRD facilities are a bit more subjective. Generally speaking, the rules would be if your CRD facility is fluctuating each month and therefore it's more used as a sort of working capital facility, you might be able to get it treated as working capital. If it is just, right, you've got a 3 million facility, you've always at 3 million drawdown on it, really that's just a loan secured against your debtor book, and therefore that's going to be a debt-like item. And then on the more positive side, cash and cash-like items. So things like cash at bank, perhaps properties owned by the business you want to extract. An important point, kind of tax point here is directors' loan accounts. So leading up to a transaction, you might be drawing from your business, and therefore you create a director's loan account whereby you owe money back to your business. Say you draw out £50,000 to kind of pay yourself. What you'd usually do is at the end of the year, you'd declare a dividend. That then clears that amount, but you get taxed at dividend tax rates for that. What you can do in a transaction is actually not declare a dividend, but have your DLA balance cleared through a transaction. What it means is that leading up to a transaction, if you just draw down from it, you build up that balance, you then clear it, that balance gets taxed at capital gains tax rates, which in the UK are still lower than dividend tax rates. So that's something to be considering leading up to transaction. In the 12 months before a transaction, don't declare a dividend. You can do it more efficiently through a transaction. That's cash-like items. Working capital, I won't go into too much detail, but effectively what they will do is a buyer will look at a period of, say, 12 months, work out your sort of average position, and then work out what the position is at completion and make a deduction. The key things to consider really are, I guess, the cash and debt-like items. And hopefully those sums there should actually give you a bit of an easier way of actually going back today and having a look through your own financials, try and get a sense of what the business is worth. The debt and cash items are things that people often forget. These are key things to take into account to get the actual value of what your shares are worth, which is the most important thing. Right, so I'm going to talk a bit about, I guess, how we move some of those dials to create more shareholder value. So talk about establishing what your value is worth now. Let's see what we can do to build up into the future. So I've broken these down into 2 key areas, really. Strategic and operational. So the strategic side is, what is the business plan? What is the sector the business is operating? What is the business's positioning like in that sector? And the operational areas are, how is the business managed? What is the supply chain like? What are the products and customers? And how does it operate? What are the systems and processes, in short? So to talk a bit about some of the sort of strategic areas of value. So starting off with the shareholder objective. So you want to make sure that the shareholders and who own shares are aligned with a transaction. So what that means is you want people to be working towards a subsequent transaction. So you want key people in your business to be incentivized, ideally through shares, leading up to a deal. Because fundamentally, that then makes them perfectly aligned with your aspirations. because you're trying to increase shareholder value. If you then get your team also aligned on the same perspective through options or actual through shares, then that means there's a real alignment between all people around the board table, not just yourself. Everyone's working towards the same goal in mind. The business plan. So the business plan is if we want to see a sort of structured plan around what the business plan is for the next sort of 3 to 5 years. This is particularly important if you're considering a transaction with private equity. So if you want to sell to private equity, you're effectively saying, I want to sell my business to you because I think I can take some cash to the table now, I can scale it rapidly in sort of 3 to 5 years' time, and in that period of time I can then sell it for a big sum. So in order to get them on board with that, you need to be able to demonstrate that you've got a robust business plan in place. So again, a really complete and well thought through business plan is going to give private equity in particular more belief in that plan and the growth aspirations of it, and therefore they're happy to invest more in it. If they're not convinced by your plan, they're not going to want to give you much value. If they're really sold on it, they will do. This links back through to the point around forecasts. You know, the plan, the forecast should be totally joined up. So whatever you're planning strategically should then be represented also in the forecast. I mentioned there, actually, you should monitor your performance against forecasts. So it's not just okay to just prepare a forecast and just leave it there and leave it in some folder in your computer and never touch it again. You should be looking at this on a monthly basis and actually monitoring your performance against it. If you can do that consistently and you're demonstrating that you are constantly meeting your forecast, then a buyer is actually going to go, okay, I'm now happy and comfortable with the value of business based on that forecast. So I think it's going to be achieved because you're demonstrating that to me. That's going to be really help. We talked earlier about what period you look at when you're valuing businesses. That can push it forward into the future, which will increase it. And yeah, it's going to be with the growth plan. So what you're planning actually should be aligned with the forecast and plan. They should all be joined up. Next, talk a bit about market. And this applies to a number of different ways. So what we're seeing, particularly in the moment, but it's always really been the case in recruitment, is acquirers are placing the most value on businesses that are market and sector focused. So having a real sector specialism provides real value because that creates much better relationship with clients and it also provides strategic value to acquirers. So, for example, if you're focused on one very particular subsector, an acquirer might want to acquire your business in order to get into that sector. If you're just a generalist and you're advising a wide range of clients across different sectors, it's difficult for a buyer to really get any traction in any one market. So if you're really focused on certain subsectors, that's a good way of doing it. This also applies to geography as well. So from a geographical perspective, having operations in different geographies provides a good strategic angle for an acquirer. So for example, say you have a big presence in North America. A lot of businesses at the moment are trying to get more into North America. It's a big growing market. If you already have a presence there, that's going to mean you've got greater value because that's a real opportunity for them to get into because you've proven that you can do something a lot of people can't do. The other side of that is you don't want to be too thinly spread. You actually want to have proper foundations in these geographies, not just saying, okay, operate across every single country through kind of remotely through the UK. You kind of need to have an actual live presence in these countries. Which again, that's becoming more and more important, particularly in the UK where the UK economy hasn't been performing fantastically recently. The sentiment in the UK economy still isn't great, but in areas like the US, it's really, really positive at the moment. So again, businesses with presence in the US are much more attractive to buyers. An example of this is our sale of Petroplan's TXM. So Petroplan will focus particularly on the oil and gas sector and in certain geographies as well. Their buyer wanted to get into the oil and gas sector, therefore they acquired Petroplan. That's why if you can have that particular sector focus, you are much more attractive to trade buyers. And then lastly, I guess, financials. And again, this covers so many different things. So one, it can be about financial reporting. Do you have the right systems and processes in? Are you monitoring key metrics? I think like here, you should be calculating on a monthly basis your adjusted EBITDA figure and monitoring that. One, for your own knowledge, because that's the measure you're going to be used be used when your business is sold. So therefore, it's good for you to keep an eye on how it is tracking. Are you paying monthly management accounts? Again, really important sort of basic financial reporting that should be taking place every month. And it's really crucial to a transaction. Without those, transaction becomes really, really difficult, actually. And then also, I guess on the performance side, fundamentally, higher margin businesses are going to attract higher multiples because they're more profitable. So businesses that have stable, high, and increasing margins become much more attractive. And we're seeing this most recently in some businesses transitioning towards statement of work service lines, which typically tend to be a higher margin because you're taking on more of the risk. You're saying to your clients, okay, I'm not going to just give you some contractors. I will take on this entire engagement and I'll source it and I'll fund it all myself. There's more risk attached to that for recruitment businesses because of that there is higher margin. And as a result of that, we've worked on the sell side, which do statement of work become more interesting and will have more value attached to them as well for that reason. So that's sort of, I guess, the strategic areas. On the operational side of it, because there's a lot to talk about here. So on management organisation, I think I mentioned earlier about the senior management team having equity. That's really important. But also, it shouldn't just be the senior management team. We talk so much in CF about just the senior management team, but actually it should be consistent throughout your whole org structure. All employees should be working towards the same goal effectively. And if the goal is to maximise shareholder value, that should be towards increasing your adjusted EBITDA. So I know in recruitment there's a tendency to, well, this comes from consultants, to have monthly bonuses based on billings and things like this. This is all great, but actually that doesn't really contribute towards the end goal, which is total shareholder value. So we try and encourage people to do is move more towards annual-based profit measures, because fundamentally that's actually what drives value. What that also means is you actually got much more alignment between those key individuals and your business. It's easier to keep hold of key staff if you can incentivise them on an annual basis rather than a monthly basis. And this could mean you can struggle to hire some big-hitting consultants who only want to get paid big fat fees every single month. The thing is, that's not really a sustainable business, because if they're making huge fees but they can just move the drop of a hat to someone else, there's no long-standing business there. Whereas you do have consultants that are engaged and see the growth of the business and they're engaged to want to grow profit, it works much better, much more alignment between all parties. So I think it's an important thing to consider. It's not just about the senior management team, it should be kind of going through a whole organisation. And also things like employee development. So again, in a sector where people move around between jobs quite often, again, if you can demonstrate an ability to bring in trainees and graduates and grow them up through the ranks, again, there's a real strength to your business there. And what that means, you've got a sustainable business. So if people leave, it's okay because more people are coming through the ranks. So I think that's important. Customers and suppliers. So I talked a bit earlier about dependency. So you don't want to have any one dependency on any one client, because there's a risk attached to that. If that client leaves or they get sold to someone else, you could lose that business, and therefore there's a risk to the business there. But likewise, clients that are blue chip are going to be more value additive. Key reason for that is blue chip clients have better payment terms, they're more likely to pay you, not likely to go bust, which is good. But also, a big strategic reason for acquiring another business is gaining access to your client book and actually cross-selling. So they provide, your client might provide certain services, perhaps the top end of the org chart. They can then cross-sell their services into your client book, and likewise you can do the same to theirs. So there's strategic value there as well. So blue chip clients, again, are more preferred. Suppliers, I think in this really should be just like your consultants. So as I said before, you want a good spread of your consultants. You shouldn't have just 2 or 3 employees making all your NFI. And this also applies to owners of businesses. Recruitment businesses, a lot of the time the owners are themselves recruiting and generating fees. But again, if all the fees are being generated by yourself, a large portion are, there's a big risk there that you could leave post-transaction. Say you're given £5 million to sell your business, 2 years' time you then leave. If you're then the main breadwinner, that's not going to work for an acquirer. So you should start talking about, okay, how can we start transferring client relationships onto like the team rather than just being focused on yourself. Systems and processes, so things like technology. Are you implementing the latest technology into your ways of working? Are you doing everything you can to be an efficient recruiter? Do you have systems and processes that are scalable? Are you doing paper timesheets? You're a contractor. Are you doing it properly through a cloud-based system? What this means is that you then have the potential to scale the business rapidly if those are in place. Again, super important if you're looking to sell to private equity. You've got to have the foundations in place for that growth. Otherwise, growth will stall when you haven't got the systems in place to actually be able to support increases in revenues. And things like contingency plans, making sure the business is set up so that if a key individual like yourself can't work for 2 months because they're unwell, there's systems and processes in place to for the business to keep operating. And then I guess last is like, legal and regulatory. So making sure that all your employees have got contracts in place, making sure they've got appropriate notice periods as well. Again, in a sector where consultants move around often, if you can tie people into longer notice periods, again, you reduce that churn of consultants, and it means you've got a more sustainable business. Less relevant here, but some businesses we talk to in recruitment now have their own technology platforms. Again, do you have like the documentation that supports the IP and things like that? So there's a few sort of operational areas there. I've just spoken for an awful lot. My voice is very dry. So any sort of initial questions on that?
I just had one question. It might be for you on the panel, but in terms of the markets, we talk a lot about the US. We've got a business in the US. How much premium do people place on actually having a physical presence versus just recruiting from afar from here? Like from the panel's experience as well, did that help in your transactions?
Yeah, I'll ask them quickly, but I can pass it over. So yeah, definitely. So I think having a physical presence is actually really important because that enables you to actually scale up in that location. I think sometimes businesses, whilst servicing a certain geography, struggle to really get substantial scale and presence in it. If they're just servicing it remotely, particularly in the US, that's definitely our experience.
I'd imagine Richard will answer this one.
Yeah, I totally agree. I think we ended up selling to a company who didn't have any operations in the US. In fact, they didn't have any international operations, and we had an office in New York that was established. We paid for and made the investment in time to get through all the bureaucracy of incorporating a business, setting up a bank account, getting the tax ID sorted, employing locals as well. And that meant we were boots on the ground. It meant if we had a client meeting, somebody wanted to see us that afternoon, we could go and knock on their door and see them. And there is genuinely no substitute for that. So I think if you are able to establish international operations, it's a massive advantage.
Yeah, I would totally back up that as well. We set up over in Boston just pre-COVID, so there was only 3 of us at the time. So it was a really tricky period because we didn't actually have a huge client base to go at. But actually, we've been out there, 6 years now, and having boots on the ground has made a massive difference. We do, really interesting hearing talking about geographies and the economy is the US. There is obviously a lot more positivity out there, and we know that the fees are so much bigger, and we do have a reasonable proportion of our UK operation working into the US now. However, I just don't think you can ever replace having people there and the ability to get out and meet our customers and to get scale. I do think it's difficult to get the same performance, I think, from UK recruiters into the US than it is US into the US.
What they said. I think the only thing I'd add to that is it depends on your timescales. So if you don't have an international office and you're planning to sell within the next 2 years, you either need to set it up today, or there's a good argument to say it maybe it's not worth bothering with because it's probably going to have a massive impact on your profit your time, the dilution, everything that you're going to be doing over the next couple of years. So you do need to consider your timescales. However, I'm quite obsessed, and probably talk about this later, around planning. So if you've got a 3-year plan, you should be forecasting when you want to go into an international location anyway, and then you can build that into your financial planning and decide when is the right time to go. So if you're looking to sell in the next 12 months and you haven't got international office, I'd probably suggest don't. I'd need to know a little bit more information, but it's probably not the best plan, because every pound will equal 5 or 6, and you're probably going to lose money within that period of time. So if it's a longer term plan, then absolutely, I think I agree with everyone else, it's the right strategy.
Anybody question? Yeah, Joe.
I'm interested in the balance to be struck between running a business that generates value now and leaving some room for growth for any further, whether that's 1 or 2 rounds of investment in the future. What would your views be on striking that balance? I mean, my assumption is that profit today is on balance more valuable than theoretical profit in the future, but I do also think about the potential, the need to be potential for growth.
Yeah, a great question. Again, for me, it depends on your plan. So if you've got a longer term plan with a financial plan alongside it, it will tell you when those pinch points are. It will tell you when you can make that investment, what return you're likely to get. Obviously, you've got to go and then deliver it. But let's say, for example, it was a 3-year plan. You might say next 12 months, year of investment. Because we can see by putting that a year of investment in years 2 and 3, we're suddenly going to get where we want to go. And from a CF and valuation perspective, if you've had good growth, and let's just say 20, 30%, so we'll keep it sensible, over the last couple of years, you then have a year where it went backwards. Revenue should hopefully be going up, of course, but the profit might be going backwards. But then the years after that are then 20, 30% growth forward. Your track record looks pretty good, and any investor worth their salt is going to look at it and go, yeah, that makes sense, and they won't penalise you for that, as long as you obviously then deliver on that return. So longer term planning should dictate that.
Any other questions? Yeah.
Hi, multiples, the multiples you showed, would you likely get a higher multiple from a US private equity firm or trade sale? Or is it pretty universal what you displayed?
Yeah, it's a good question. We get asked this often, actually. I think the sentiment is that US businesses are likely to offer higher multiples. The reason for that is if you compare a UK-based PLC, they are trading at lower multiples in comparison to their US counterparts. US counterparts themselves are on high multiples, therefore they can pay a higher multiple. Fundamentally, a UK business, if it's trading at 6 times itself, it can't pay you 6 times because it's diluting. Whereas if it's in the US and it's on 12 times, it then could. So that drives it. But also it comes down to appetite and financing. So US businesses at the moment are performing well. So if they've got strong performance themselves and they're well funded, they're just able to generate high return, and therefore they're happy to pay a higher multiple. So for those 2 factors, that is the case. I do want to say, US trade sale, it's not the silver bullet. Everyone talks about it as being a sort of perfect transaction. In order for a US trade sale to be your sort of goal, you do need to make sure the business is significantly scaled. Because businesses in the US are significant themselves. So we tend to say, your business wants to be sort of 2 million EBITDA plus before US really gets interested, because they are operating in a massive market. These are huge businesses. So I think that's something to bear in mind. But yeah, no, you are right. I think in our experience, they are willing to and are more able to pay a high multiple.
Thank you.
One thing I was going to ask Tom actually is just as regard, how have those multiples changed from your perspective historically from 2022 to now? Because there is quite a considerable difference there.
Yeah, exactly. So I think multiples have come down the last couple of years. And the reason for that has largely been business performance more than anything. I think recruiters have found it more challenging the last few years. Not only does that bring down the profit measure, but also it brings down buyers' expectations of future performance, which really is what drive multiples. So high multiples are applied when businesses are expected to grow a lot in the future. So because growth is kind of, listed businesses have been cutting growth forecasts and things like that recently, that's brought them down. Sentiment-wise now, we're seeing more positive sentiment, but we need to see that being delivered into actually improving performance. And we need to see businesses starting to beat their forecasts. And that will then hopefully start to see multiples drift up again. But also another, because a macroeconomic factor was before we had really low interest rates, whereas now interest rates being much higher, the cost of financing transactions is much greater, particularly for private equity as well. So that also changes the dial there. I think generally speaking, in the lower mid market, multiples don't fluctuate so much as in the top end. So whilst they've come down slightly recently, it's still probably within that range. But we're sort of fairly positive for the next 12 months that as business performance starts doing better, we should see these multiples starting to increase if we get more confidence about the future.
I have a question, Tom. Okay, thank you. Appreciate it. I'm sure there's a million and one reasons here, but what are the most common reasons that a deal will end up invariably falling out?
Yeah. Wow, I've experienced so many different other reasons for them to fall down. But the biggest thing really is business performance, in truth. And it's hard to control that to a certain extent. But when we see transactions fall through, it's usually because the business is now not hitting its forecasts. It's now trading backwards each month. The challenge with that is the buyer's then going, okay, what is maintainable? Because every single month the dial is moving. I can't then get comfortable about where it stops. You're catching a falling knife. So that's the biggest thing. So I guess all I can say to that is it's important to keep focusing on the business during a transaction because it's easy to get sidelined. To help with that, it's making sure you've got the right people supporting the transaction. So if you're still actually actively working the business, you need to make sure your FD or your finance team are actually involved in the process. So key people aren't being brought out of working during the transaction. But also it's about picking a good time. So when you're going, okay, my forecast is looking good for this year. I think this year's going to be a strong year for us. That's the time to start a process rather than going, which are the best year ever. Let's now start a process because the numbers go in the wrong direction. So that for me, that is probably, half a transaction to fall through is for that. There's also a variety of other reasons, but that's the biggest thing that people should focus on by maintaining that going forward.
Can I just quickly add one more point to that? So this is a real experience that happened last year. It was a company who I'm obviously not going to name for obvious reasons. They tried to go to market. Good business. I'd actually previously advised their competitor, so I got a good feel for them. And they were unsuccessful when they went to market. They got right to the last stage, and the reason why they were unsuccessful was when they started doing the senior leadership team due diligence, they found that most of the revenue was coming from the founders, or they were generating most of the revenue. And the senior leadership team wasn't quite experienced enough in the roles that they should have been doing, et cetera, et cetera. So that one fell through literally at last minute. So they got their hands on the millions, almost thought it was happening after about a 6-month process, and then it all fell apart at the last stage. Now, they then got sent to me, and we're now working on that, and we're sorting out all the things, and it's going to be fine. But it can be a key reason, particularly in SME recruitment companies. It's very typically the rainmakers, the lead people, the biggest billers are quite often the founders, or there's too few people. And I've seen another one where, and this might sound amazing to you, but there was a firm, recruitment company, where there were 2 people billing over £1 million. In fact, one was doing 3.6 million on their own, so pretty exceptional. However, when it came to valuation, because there were 2 out of 40 people and the rest of their average was about 150,000 per head, they actually removed both of those amounts of money before it came to the valuation. So that spread of recruiters is actually better to have an army of people doing 200, 250, whatever your market is, than it's having 2 exceptional performers at the top.
This is just a question on the data that produced those multiples for the listed businesses. You said the share, it was based on the share price yesterday.
Yeah.
What financial period was the profit calculated on?
So that would be sort of last 12 months, or listed businesses, the latest earnings.
Because Walters announced no profit, I believe, in the last 12 months, and you had them at 6.2.
Well, it's either going to be historic looking or something looking forward-looking perspective.
Oh, okay, fine.
Listed businesses disclose forecasts. So because of that, often the PE multiple will actually be more forward-looking. So I'm not sure in case of that case, but that might be the reason.
Yeah, nice one, thank you.
So again, that links back to my forecast point. So you don't want to be looking historically, and we're looking in the future. In listed businesses, that's always the case because these businesses. Because these businesses have to and are required by their shareholders to announce forecasts all the time. So the stock market and the stock market in general is a forward-looking measure. So actually, historics are irrelevant. But in SMEs, often historic is all that's looked at because people don't have forecasts. So that'd be the reason why.
It's also a little bit misleading, if I might add, because these are listed companies. So when you're buying shares in them, you're not buying the majority of a company. And when they're buying shares there, they probably don't have a lot of the rights that you might have. So if you're buying a controlling stake in a typical recruitment business, you're going to be buying the A-class shares, dividends, voting rights, full control. Anything else is going to be severely discounted. So it will be confusing, I think, to look at a typical recruitment company against Robert Walters, because they're just a completely different beast, and you're buying a different way into them as well.
Excellent. Any more questions? Yeah, Lisa.
I have a question, probably more for Chris and Richard, but how do you decide what is the best value creation route for your business? Obviously, you went down an EOT, you sold to a corporate. What was your sort of thought process, and how did you decide that was the best route forward?
Initially, we were looking at first and foremost. I'd say it comes down to what Tom was mentioning. What do you want to get from it? What's your kind of time scales? What's your kind of views? And is all the board and shareholders aligned with the direction that you're going in with the transaction? We initially were looking and going down the road of a minority sale. So we're looking to get some money up front, but for us, we were still heavily involved in the business and wanted to be heavily involved longer term. So but there was no kind of immediate exit strategy or 2-year strategy. We were kind of still early on and are still early on in our journey. So that played a part in our decision making. And then we came across the EOT, which was created in 2014, I think it was, and is still actually, I think there's only less than 2,000 businesses in the UK that have gone through it. But it seemed the right vehicle for us. We'd just come out of post-COVID. Despite it being a really tough time, it was a really galvanizing time. And what we wanted to do was, yes, financially do well from it, but however, actually give something back. And again, it comes on to the point about everyone having a common purpose and common drive. So the fact that the EOT, what it is basically we sold 60% of the business, and coming on to valuation, you do have a certain degree of influence over that valuation with an EOT. Obviously, we had to have it heavily audited and make sure that we got through all the kind of elements we can do to make sure HMRC pass that. But you do have probably a little bit more degree of influence around that. And it was kind of, again, post-2022, which was a fantastic year for the business. So from a valuation perspective, it worked well. And it just seemed the right time to do it. From a tax perspective, the disadvantage about an EOT is it is paid through the profits of the business. So you have to be comfortable and confident that your business is going to perform for you to be paid. And that's the disadvantage of it. And obviously the last 2-3 years hasn't quite been the market for most people that we wanted. So we've had to be patient with that. We're able to get some money off the table. But the true benefit of it is twofold. One is from a selfish perspective, you pay 0% tax. So big plus, especially with the ever-growing kind of taxation that's hitting us left, right and centre. But it's also just to try and galvanise and keep your top performers, but they've got to believe that as well. So, hitting that EOT, there will be life-changing sums of money for those individuals that have been, it's usually done through the longevity of their employment and the seniority or their salary. So there will be life-changing sums for those. And it was just a personal thing for us. We wanted to reward the people that are given most back to the business. And we all appreciate, look, people can go off and set up at any point, so we wanted to make sure that we were giving something tangible that they could see and feel and touch back once we hit Financial Freedom Day, which is once all the loan notes are paid off. Sorry.
our journey was quite different in that I think you need to ask yourself, what is it you want to achieve from an event? Is it sort of wealth creation? Is it tax efficiency? Is it the opportunity to kick on and really grow and scale the business? And in our situation, we had a really healthy company. We were very profitable. We had great cash balances. We didn't need money. Without sounding arrogant, we didn't need money to do a deal. But I was working insane hours. I had a young family. We had offices in New York, offices in London. We were doing loads of work at the time in Russia as well as in Europe. So the day was extremely long. And the people that I had in my business that we were trying to bring up just didn't have the skills or experience to help support in running the business. And so we went out to market, we hired some people, and again, because we were a relatively small owner-managed business, they perhaps didn't land as well as we'd hoped, and they certainly didn't have the same approach to the business that I do. Because, of course, when you create and build and scale something, it's your baby, and no one's going to be as passionate about that as you are. So the reason that we then started talking about going out to market was because I wanted to engage with other people who could support me and who I could learn from. I felt that after 15 years in the company, I'd learned all I could within my own business, and I wanted to learn from other people. We spoke to 2 search firms initially. They approached us and they wanted to acquire us because they liked our client book. But when we dug into both of those potential deals, and we're going through the due diligence, one of them we backed away from simply because their balance sheet was flaky as hell. They literally had about 6 weeks working capital. And they had a huge lease on a nice new office in Holborn, and they wanted us to fill that empty space for them, so that wasn't going to happen. And the other one was a cookie cutter, like an acqui-hire. They were very similar to us, same market, similar clients. They were just trying to buy us to acquire the team, and that wasn't creating any value at all, and it wasn't actually answering the question, which was how do I learn more, how do I grow as a human being, as a professional, and how do I engage with people who were better than me, who got more experience than me, and that was the primary objective of selling the business. The company we ended up selling to were a public company. They had a breadth of services. They were a contract recruitment business. They had a MSP, RPO business, so solutions business. They built a consultancy, statement of work business very, very successfully. And they did low-end IT perm business. So they did everything within the suite of recruitment except exec search. So we sat down with the chairman and could identify really clearly how we'd complement the rest of the group and how our skills and experience could contribute to their business, but equally how their client book and the business they weren't writing with their client book could be complementary for us and a good route to market for us. So it made a lot of sense for us to go corporate. PE for me was never on the table because we didn't need the cash, and I didn't want to start reporting to an external shareholder who perhaps didn't understand the business and he's just going to beast us because we spent too much money on coffee or something.
I've got a question for you, Chris, but it could put out to the panel as well. If you had to start from scratch today, what 3 areas would you focus in on to get the most success?
I think, again, we've touched on quite a few points around it. I think just focus in on being brilliant in the market and a really tight market that you're in. I think from a geographic, we were UK heavy to begin with, and I've gone out to the US, so I would have hit the US earlier. And we've always traditionally been a perm business, so it is always hard scaling recurring income from a traditional perm business. So again, we've gone down the total talent solutions route as well. So a key aim for us at the moment is all around that customer obsession. You know, I think the days of just piling hundreds of bums on seats in recruitment is going. And I think it's a lot now around profitability and productivity per head. So that's a key focus for us at the moment. It's a real change of tact and strategy, but it's also about how can we maximize that client spend and ensuring that we've got services to accommodate that around all our customer base. So probably more than anything, hit the recurring income earlier and get experts in that truly understand that market. And making sure that we're leveraging all our client base.
Excellent. Anybody else?
I'm relatively, another obsession of mine is the 3 Ps, so process, planning and people. So in addition to everything that you've said rather than instead of, having the right plan, I've said it a lot of time before, will help dictate what you're going to do. But the key to really good planning is 3 years. Anything beyond 3 years is too far away. Anything less than 3 years is too short term. So 3 years, put a line in the sand, exactly say what you want to achieve at that point, build the org chart of exactly what you want, put people into the places, the divisions, the teams, you can see exactly visually what you want your company to look like. Now the key bit is to reverse engineer the entire process across the key milestones. So things like people, number of clients, average fees, average margins, et cetera, geographical locations. Then for the next 12 months, each month, have those key milestones alongside your financial plan, and then monthly accountability. Someone mentioned it before. Every month, a operational board meeting that says, are we ahead of those milestones? If you're ahead of them, great, well done, fantastic, pat on the back, what's the next ones? If you're behind, because it's only a month, if it's a mistake, you can turn it around and get yourself back on track. If you do meetings quarterly, it's too far away, it's 3 months gone, it'll probably affect the next 3 months, that's half a year in a year plan, way too long. So 3-year plan, reverse engineering things, that's the planning side. Processes, make sure everything's completely repeatable and scalable and easy. What you're trying to create here is fundamentally a recruitment company in a box. So anyone that's buying your business can come in, and if you lot unfortunately get run over by a bus, then they can go, right, I can pull out the drawer and go, what is it? So hiring people, A, B, C. Winning business, A, B, C. Everything is really neatly done across all the key processes in the business. And there are 15 core pillars in a business. If anyone wants to know what they are, if they email me afterwards, I'll send you a document because I've broken down every recruitment company into 15 core pillars that you should make a process. And then the last one, people. It's recruitment after all, but I had this debate with a friend of mine recently about what's the right person. I said, by definition, the right person or the right people are the ones that deliver the success. Because if they don't, they're not the right people. Do you have to manage them? Do you have to develop them? Maybe a little bit, but actually they're the right people. You don't have to, because they're the right people. So make sure you spend more time on your processes, your interview processes, your brand, your culture, everything you're trying to do to attract people into your business. So then make sure you've got a great interview process, you're getting the right people so you don't make as many mistakes. You've got great onboarding, great training, learning and development, rewards, meritocratic career structure, et cetera, so those great people stay with you, and so you get the benefit from all those individuals and your hard work.
Excellent.
I think, just quickly on that point, I think our whole industry has grown and matured a lot over the last 15, 20 years. And previously it was very transactional. You know, you'd phone a client, have you got any jobs on, can I help, throw CVs at them, do a deal. The market's become so much more sophisticated now, and clients expect so much more from us. And as we go about the day-to-day, we're gathering a lot of data and insights within the market. We have a lot of intelligence around what's going on in the world that our clients find really, really valuable, especially in a world where they've got growing talent teams of their own. So we have to become, and this is something that I only figured out a few years ago, but we spend more time now on our customer strategy and how to engage with our customer, how to ensure we're delivering all of our services to those clients. Previously, we were very relationship-based, so we all know people, and you tap them up, and they would be your clients who would give you work and keep you fed and watered and busy. If you sit down with your colleagues and start pulling on the threads and seeing who knows who and what services we can deliver into each of those clients, you can build out a customer strategy, and then hold each other to account on it and focus on that, because business development is a really, really, really expensive activity. And if you're winning clients by making 1,000 phone calls, that's very time consuming. Whereas if you've got a client that you've done some good work with, then you should cross-sell into that account. You should be selling them consultancy, you should be selling them interim, you should be selling them search. The clients love you for it, because a bit like when you go to see your family doctor, you don't expect them to be a specialist in everything, but you expect them to know and who is the right person to deal with whatever ailment you have, and they point you in the right direction, they introduce you to the right people. And that's very much how we work now. We kind of work very closely with our clients, and I might not solve the problem, but I know a colleague who does, and I've got a load of them behind me who I'll bring through to those clients and grow the accounts that way.
Richard, I've actually got a question for you. When the acquisition happened with Interquest, how did you manage the culture along with managing your kind of key personnel, embedding them into that new iteration?
really good question, Leith, because culturally we were very, very different. And also I had a team in the US, and Interquest didn't have anybody at all in the US. So for a start, I had 2 or 3 people on the team who had share options in the business. So they were, whether they liked it or not, they were locked in and had to stick around for a few years to get the earn out that they wanted. We spent a lot of time. I took the whole team around to all of Interquest's offices across the UK. We presented to the company, to the group, to introduce our business to the group. There was this really strange expectation that we were going to be a bunch of guys in really expensive suits who went to public school and, were just dicks, basically, in the eyes of a lot of the Interquest guys. And very quickly they learn over a beer that we're all basically doing exactly the same job. We all have the same backgrounds. We all have the same fears and concerns and expectations and ambitions. And that helped to bring us all together. I do evangelize a lot on the point I've just discussed, which is working in service to the client and being very, very client-centric. So one of the best ways we could get the Interquest guys on board with us is to bring some of their teams into some of our accounts. And we work with, I'm a professional services guy, so we're working with Deloitte, KPMG, EY, Alex Partners, FTI, A&M, big global organizations that a lot of the guys in Interquest were trying to get into and they just couldn't get through the door. Whereas we could bring them on a client meeting and sit down with a client and say, look, you know us for doing this, but I've got a team over here. In fact, there's 50 of them, and they can do all this mid-market stuff for you that you've been struggling with. And you can do it all through us, so you don't have to deal with 25 different other contacts. And that's when you start developing almost like an enterprise account relationship. So that helped to win over the Interquest guys. At board level, it was simply we just had to produce and get the results, so the money was coming through, so built bridges across the board very quickly. Within my business, it was tricky because there were 1 or 2 guys who wanted to work purely within search and didn't want to be part of a broader talent organization. And some people chose to stick around and some people chose not to. Some people embraced the opportunity because they, like me, they wanted to work across different sectors and deliver work at different levels. And some didn't, so they either got on the bus or they didn't, to be frank. It wasn't helped by the fact that because we sold to a public company, we had to keep the whole deal totally locked down until the morning we did the deal, then we could announce it internally. So we did the deal at about 8 o'clock one night. It was meant to be 3, but there was a last-minute negotiation. But I got the whole team together for breakfast the following morning, 8 a.m., introduced them to the CEO and the chair, and everyone just started talking and seeing how we could make it happen.
Thank you. Anybody else have any questions? I know that we've overran slightly, but I would like the panel just to kind of give a brief synopsis of their experience with EOT, etc., if possible, Chris, and what you've learnt from it and the key takeaways, if possible.
Yeah, I'll keep it brief. A lot, I would say. I think for me, the key was not to have it as a distraction from day-to-day performance. So I got literally, it was myself and the other founder and the CFO that were involved in it, and I really wanted our key sales directors to focus in on carrying on doing their job and not kind of ruining our momentum that we were building. So that was a really, really key thing. Getting a brilliant advisor on board is always important. So we went out to market, happened to pick the most expensive one, but I have to say they did a fantastic job and really helped us through it. So that gave us confidence. And we ended up doing it within a 3-month window. It was bloody intense though. So again, timing, traditionally December and Jan for budgets and everything else is a really busy time. That's when we ended up doing it. It was pretty brutal when it came to it with the times that were worked, but we got through it and we delivered it. The key thing learning I took from everything was talking to other businesses that had gone through it. So there's quite a few recruitment businesses that had gone through an EOT, and I really sat down and spent some good time with them pre it, and they were really open to what worked well, what didn't work well. The key element that didn't work well was a lack of understanding and communication afterwards. So what we did was delivered really clear presentations, but then sat down in smaller groups around peers and had a really open Q&A session and tried to explain it very clearly what it meant to them. So the understanding was there on what it meant to them, which I think we got absolutely right, but it took a lot of time and investment.
Thanks. The best time to start planning for an exit is today. And the longer the period of time you've got, the better, because the more you can influence the valuation, the profit. You can take your time, you can do things sensibly, you don't have to rush. It can be a lot of hard work at the last minute, and if everyone starts doing it, I have a lot of people go, oh, I want to sell in a year. That's a hell of a lot to suddenly do in a year. There's quite a lot of admin and operational stuff that you want to do involved. So if you can start thinking 2 or 3 years ahead, you can start planning it out, think it like a project management tool, and each month start doing things towards it that way, and also getting other people in the business to help you where possible. That way it will be done in a more considered way. And as I say, you're more likely to get a bigger return because of the things you put in place to improve the business along the way.
Alex, I've got a question for you specifically. What are the key learns that you've had in advising businesses to create value over the last 10 years?
How much time have we got? This is a long one. Gosh, there's so many things. Well, obviously one of the points I've just mentioned there is absolutely critical. Now, you probably expect me to say this, but actually there's a good reason I'll back it up. Getting the right people, the right advisors, as Chris said before, is critical. So people that have been there before, and the more they've been through it, obviously the more experiences they've got, because what's right for one company isn't necessarily right for another, and vice versa. So your experience might not be exactly aligned with another person who's been through an exit. But obviously if that person's been through multiple exits, it's more likely they're going to have ideas which are similar to what you want. And of course you can learn from their successes, and most importantly learn from their mistakes as well. I mean, why make the mistakes that other people have already gone through? And I would say that if you look at most business issues, probably 90 to 95%, the mistakes have been made by thousands of founders, thousands of times before. So search out people who are going to go through a likely similar experience to you, and I think you're likely to have a better run because of it.
One thing I was going to just ask you is cost. We haven't mentioned the cost of transactions. What is your experience and how's that varied? Because it's something massive to take into account.
Yeah, it's a great question, and I'm sure our learned friend over here will try to avoid that. No, we'll want to answer that. Look, it will depend on the size of your business. I mean, typically, if you go through corporate finance, M&A, they will charge a percentage. There'll probably be an upfront fee for information memorandum, an exclusive arrangement. They'll then long list the market, work with you. They'll short list, get involved in meetings. So there's quite a lot involved with that. I think ultimately what you've got to do is the likely valuation. So if you're going to walk away with 10 million and it costs you £250,000 in corporate finance and legal fees and other advisory fees, not probably a million miles away, then you might think, well, that's not a bad deal because they've made it happen, and okay, it's £250,000, but I've still got 9 3/4 million, I think my maths are right there, still to go. So I'd look at it as actually the overall return on investment that you're going to get rather than necessarily the cost. But there is, if it's corporate finance and if they're good, they probably will be charging an upfront fee, but be careful because obviously there are some out there that will promise something, for example, £5,000 broker upfront fee to go and find someone for you. Personally, I'd be very wary of someone at that end of the market. It sounds good, but they're probably not that talented. If there's someone like RG, who I've done 7 transactions with, I know their track record. They will charge more, but they deliver behind it. So it's worth paying, I would suggest.
Richard, anything to add?
Is that okay?
The only thing I'd add is I think having a good corporate finance advisor, they more than cover their costs. They increase the value of the deal. They increase your deal value. These guys found costs in our business that we could remove from our P&L to increase the valuation of our business, and that more than covered their fee. So it became a bit of a no-brainer.
Wow, that's very flattering for everyone there. Yeah. No, all I was going to echo is I think Alex's previous comment around the best time to start planning an exit is now. I think that's so crucial and so pertinent. And I think we always advise our clients the best thing to start off with is carrying out an actual valuation of your business now is so important, and actually working out where are the areas that are going to detract from your value. Working them out now gives you plenty of time to then sort those out. But unless you kind of get people involved and get consultants and advisors on board to help you identify those, you won't know about those until it's too late. So it's really important to kind of start have that as the kind of start of the strategic process, and then you have a plan from there for, say, 3 to 5 years out, going, right, okay, these are the areas we need to work on in order to actually build our value, and therefore we've got time to now fix these things. As Alex says, the worst thing you can do is go, I want to exit in 1 year's time, but actually you haven't got the time to, start spreading revenues between consultants and start to focus on certain sectors and building client relationships. You can't do that in a year. So the more time you have, the better. And it also means you actually then work out, okay, well, this is how the value is determined. Okay, this is how actually we're going to start build value. We're going to start focusing on adjusted EBITDA rather than NFI. And we're going to start trying to make a more sustainable business rather than just looking for the biggest fees we can short amounts of time. So I think, planning is just so important, and the sooner you start that analysis and that work, the better.
And if I can just add one final point, an honest review of your business and its valuation. Everyone knows the things that they're doing well. I quite often find recruitment founders are a bit unrealistic in terms of how amazing their business is. It's unique, we're different, I hear quite a lot. Sometimes it's not quite as unique as you think. So actually having someone coming in and telling you the hard truths about all the reasons why you won't achieve the value you want, all the mistakes in your business, all the things you need to improve are just as important as all the things that you can do well. Because of course, if you can remove all of those, you're likely to be in a stronger position, more likely to get multiple offers, which of course is the aim of the game, because then you're in a position of strength for negotiating.
Excellent. Any more questions? No? Well, look, thank you very much, panel. I really appreciate it. And give them a round of applause.